For today, we got the much anticipated and exciting topic of taxes, cost segregation, and all of that stuff. And trust me, I know if you're anything like me, you might regret this subject matter just as much as I do. But understanding it is huge because it is extremely helpful as you go to do taxes. Like now it's tax time, and issuing the K1s and seeing how you and your investors could benefit is absolutely huge. So today we're going to talk all about that, all about cost seg studies, what they are, how you can use them, when you should use them, what's the benefit of them, a little bit of nuances around them. So let me preface this by saying I know that we got a bunch of smart, intelligent people that look at this. I'm not an expert. Here's what I do with cost segregation study. I pay the money, I give it to a professional gives it back to me, and then I give it to the CPA, right? And I mainly understand what it is and how it works, and just enough to ask the basic questions. So this will be level 101. It definitely won't be a huge deep dive into a cost segregation study and all the different nuances and tax laws and codes that go along with it. But the goal is that you have an overall understanding of what it is. Then you're able to take that, use it to your advantage, apply it as you do deals going forward. And it's also great for investors. So we're going to talk about how investors can save, if you invest yourself, how you can save, and if you are active and you're looking to attract investors, how cost segregation studies can be used as a way to appeal to investors who are looking for some tax savings, which oftentimes they are. So let's go ahead and just hop right into it today. What I would do is give a brief introduction to myself and who I am. So let me go ahead and share my screen. And if you were with me last week, you probably remember that I stated that there will be a new website, and there is. So if you are able to see my screen right now, how are my people on Zoom doing? Am I visible right now? Okay, I think so. So you're looking at realapartments.com. This is the rebrand of snscapitalpartners.com. But we rebranded, updated the website, but you can find out more about what we're doing. We're focused on affordable housing, but we're still in the multifamily syndication business. So you can read up on what we're doing with section 42 real estate with affordable housing, how those investments works, as well as find out more about our team and a little bit there. There's also some deals that we've done, properties that we closed on, so that you can learn a little bit more about us as a group. If you click on the team, you see like our team members, find out a little bit more about us. And then also, if you click on the Invest Now tab, if you want to hear about these opportunities that we have in multifamily, you looking to save on tax savings with a syndication deal, then come here, fill out this brief form. That'll put you in our database. That will allow us to reach out to you when we have deals, and you can decide if they work for you or not. So with that being said, let's go ahead and dive into it when it comes to cost segregation. So what is a cost segregation? Basically, it's breaking a property down into various components so that you can accelerate the depreciation on that. So stick with me a little bit if that definition wasn't necessarily clear. We'll talk about why you want to do that. All right, so we have three different types of depreciation when it comes to real estate, right? You've got straight line depreciation, you've got accelerated depreciation, and then you've got bonus depreciation. All right, so when you buy a property, you're able to write off things like interest, things like repairs that you made on the property. In single family, you also do that in the multifamily world as well. So you have commercial depreciation or straight line depreciation, and you have residential straight line depreciation. So it's 39 years for commercial property, which is like if you're talking about a restaurant or some retail office space. Usually they take the price of that building, and then over the next 39 years, you will save up what you initially paid on that purchase. For multifamily, which is evaluated as commercial with the income approach, is actually considered residential. So it has a 27.5-year straight line depreciation schedule. So meaning if you buy a $10 million building, over the next 27.5 years, you should save in taxes $10 million. right? So that is straight line depreciation. Now you also have accelerated depreciation. And this is what we do when you do a cost segregation study. So what you're going to do is you're going to take that building that you purchased and you're going to break it down into its various components. So you're going to say the roof, and you're going to talk about the doors, and you're going to talk about the countertops, appliances, doorknobs, and even use windows, right? All of these have various shelf lives. So ideally, this tax code is saying that not everything about this property is equal. So even though we're going to depreciate it over 27 and a half years, you're not going to keep the same microwave for 27 and a half years, right? It's going to depreciate faster. So with that, you break it down into those components, and then each one of them get assigned a shelf life, and usually something like 5, 10, or 15 years. And what you do is with that, now instead of taking the 27 and a half year reduction in taxes over that period of time, you now break it down to 5 years or 10 years or 15 years. And what that does is it gives you more tax savings in the beginning, right? So as you are early on in the purchase of your property, you now have additional tax savings. And what we do is we typically project a 5-year hold on our properties so that investors really benefit from those tax savings early on in the process. So with doing that, you fast forward that, and basically you are able to make money, right? So this year we send out monthly distributions, but to our investors, it looks like they didn't make any money, because when it's said and done, we took so much of that. In this example, call it a $10 million deal, and we accelerated that in the beginning of the deal. So it's like, even though you earn money, it doesn't look like you did, which is very beneficial when it comes to saving on taxes. So you also have bonus depreciation, right? So straight line depreciation, you got accelerated depreciation, and then bonus depreciation. Bonus depreciation is like if you go out and you rip off the roof of an apartment complex and you replace it, call it a $500,000 roof replacement. Well, you used to be, as of last year, able to just write off that whole $500,000 as bonus depreciation year one. Right. That's what you were able to do. Now they're starting to phase that out. So in 2023, I think you can do like 80% of whatever you spend, and it's going to go down to 60%, 40%, and so on. So they're phasing it out unless we get somebody else in office who decides to reinstate it or something like that. But just understand this. But when you take those two things into account, that being accelerated depreciation and bonus depreciation, now you're really looking at front loading your tax savings in the beginning, right? So that you can actually defer those taxes to a later point in time, right? So the benefits of these benefits of cost segregation for multifamily is that you get tax deferrals. And I have to stress that it is a tax deferral and not necessarily a tax saving, right? So if you write off a lot of money in the beginning, right, and then you sell that property within 3, 4, 5 years, whatever it is, then you have what you call the recapture tax, right? And I'm smiling right now because I know that I've sold property very early on. I was like, what the hell is this recapture tax? Why are we paying all this money now? But if you don't do some of the strategies that I'll tell you about in a minute, you will have a recapture tax. So what is a recapture tax? Basically, the IRS says if you sell that property and you do not own the asset for its complete tax lifespan of 27 and a half years, right? Then you have to pay those savings back. And they basically go in a straight line depreciation. So you get some tax savings, but the bonus that you brought forward, you now have to pay that back. So why are we doing this? You'll get to that in a little bit about how you can actually use this as a deferral. But what I want you to know as you're first getting into it, when you talk to your investors, or if you are an investor, you always want to be cognizant of that recapture tax. So to understand a recapture tax, you have to understand what your basis in the property is, right? So if I'm going over anybody's head, stop me. But if not, if I don't see any questions come through, I'm just going to keep rolling, all right? To understand the tax savings, you have to understand what your basis is. And so let's just start with that example. Say you purchase a $10 million building, and we will say that to keep the math simple, let's just say you bought it all cash, right? So this $10 million purchase of multifamily. Now, you do not get any tax savings on land. right? So you have to take the land value of your purchase and discard that from tax savings. All right. So now if you said that the land evaluation was 2 million, now you got $8 million of what they would call improvements. And that's what you're going to be able to force, accelerate depreciation on, or get bonus depreciation on. So out of that $8 million, let's say you did a cost segregation study and you took $4 million of accelerated or bonus depreciation during that time, right? So you bought it at 10 million, excluding the land, you're at 8 million. You took $4 million of that in depreciation. Now, let's say you sell that property for 12 million. Okay. Your tax basis will be calculated like this. You bought it at 10, you sold for 12. That's $2 million. So IRS gonna knock on your door, say you got $2 million in capital gains that you owe us. Now, when you bought it at 10 million, you also had an additional $4 million of bonus depreciation that you took off over the time that you own it. Bonus or accelerated depreciation. So now you got the 2 million and the IRS is going to come for that 4 million. So you have a tax basis of $6 million that you will have to pay taxes on. Okay. So like, all right, the way you leverage this though, the way that it's useful to you is that you roll the money into a 1031 exchange. So you take large sums of accelerated or bonus depreciation, and then when you go to sell, you do that in a 1031 so that you don't actually have to, or you can avoid paying taxes, and you can defer and you can defer and you can defer. And there's a whole nother subject on how to do 1031s and how that works. But if you set this up and when you're working with an operator and you're thinking about investors, you want to make sure that they do this or that you talk to them about it, because it's something that you have to do in order to be able to, something that you have to do in the beginning in order to be able to do a 1031 exchange, right? So you want to make sure that you set up, and it's not the easiest thing to pull off. But if you do it, you're able to earn income, you get your monthly or quarterly distributions. Then you pay no taxes on that. And then at the end, you simply roll those capital gains into another asset, right? So you understand how you can just keep rolling and rolling and deferring those taxes down the road. And you can actually do that through your entire lifespan. Okay. So any questions on that? We understand basis. We all good. All right. I'm moving on then. So when it comes to how do you utilize this cost segregation study? First, if you are a passive investor, then you can use this to offset your passive gains. So let's say you invest a certain amount of money per year into apartment syndications or apartment complexes, whatever that is, right? Each year that you earn income passively, you can use these passive losses to offset your passive income. So that's for passive investors. So you can earn $100,000 in passive income and then write off $100,000 in passive losses. Okay, that's how these are beneficial to you. It's even more beneficial to you if you are active and considered a real estate professional. So I talked to several real estate agents and people who are classified as real estate professionals definitely need to be involved in syndications because it's just too beneficial for you with these savings. So what's a real estate professional? How do you qualify? I qualify as a real estate professional. The criteria, and talk to a CPA because I might screw this up too, but basically the qualifications are you need to spend 50% of your time or more in real estate. So it's got to be your primary focus of your time and work. Okay, then you need to do at least 750 hours a year in the business. So usually most people qualify very easily on the 750 hours a year. Where it becomes challenging is if you are working the job. How do you do more in real estate that you do in your regular job? And that's where that 50% test comes in. But it's great if you have a spouse that doesn't work, or maybe works part-time, and then they're able to do more in real estate than they do as on their job, or maybe they don't work and they just do real estate full time, because those real estate professional tax exemptions pass along to you as a whole. So me and my wife were able to utilize this. So even when I was still working the job, she could qualify as a real estate professional based off of that, right? Because you're not working now, you get the benefits of being a real estate professional because the majority of your time is in real estate. And now you could take all of those benefits and you can actually offset your earned income. All right. So we talked about passive income. For a passive investor, they can save off of passive investment income. But if you qualify as a real estate professional, you're actually able to offset other income. So you can have a spouse and maybe they make $200,000 a year. But if one of you all qualifies as a real estate professional, now you can reduce your overall taxable liability by your passive losses if you qualify as a real estate professional, which is huge. With all of that, don't take my word for it. Reach out to a CPA who knows this and allow them to sort of walk you through this process. With that being said, let's talk about CPAs. And let me just say this, not every CPA understands these laws. And if you reach out to your CPA and you start talking about real estate professional or 1031s and cost segregation studies, and they're not familiar, like it doesn't just roll off their tongue what we're talking about, you need to go find you another CPA because they could be costing you money. You want to find someone who specializes in this section of the tax law and understand what you can do and keep yourself out of trouble, right? So select a valid CPA to understand cost segregation studies. They understand recapture tax, and they'll be able to guide you through this way better than I'm doing right now on this quick introductory webinar, right? So what's the process of a cost segregation study? It's like a mouthful to me. What's your process like, right? You use it when you first buy a property, all right? When you first purchase, you want to hire a company to do a cost segregation study, and then you will use that going forward. Now, you can do it for prior years. If you're just learning about this information now, you already own some multifamily assets, you can actually go back and do a cost segregation study from 2, 3, 5 years in the rears, and they can bring you up to date. But it's best to do it right at the beginning and then start passing those savings off to your investors. So the way that we do it is we will purchase the property, do a cost segregation study, and then we hand that off to our accountant around probably 2 months ago when we're getting ready for our K1s, beginning of the year. And then they take those cost segregation savings and they start issuing them out to investors. So basically say, hey, you earned this much based off our distributions and you save this much based off of our depreciation schedule. All right. The cost segregation study, there's plenty of firms out there. We've used Madison Specs several times. There's other ones. Just talk to people in the industry, right? Find companies that are reputable that you can use and get recommendations on. And the cost of doing one of these studies, it varies by the size of property that you're doing. So if you're doing a smaller property, it could be as low as maybe $1,000, $1,500 or so. If you're doing a larger property, it can go up to $10,000, right? They have someone come out, they'll do a study, they will walk the property, break all the components down, sort of understand the land value of it. It's a whole process that they do, right? But cost you some money, but it will save you money in the long run. And it's extremely powerful as you do that. So with that being said, we'll open it up to see if we have any questions about what was covered here. Jim says, I do cost segregation studies for people and give them an estimate and price up front. So, Jim, every time I talk to you, I find out something else that you're good at. So, all right, I did not know that, but yeah, we could talk. So if you are on Zoom, Jim, you want to put in your contact information so people can reach out to you, or even if you want to you're unmuted, so you want to just tell people how they can get a hold of you.
Yeah, well, you have it on the you have it on the email you send out, but I'll put it in here.
Yeah, just in case there's somebody who watches this.
Yeah, I'll give you an example. I'll give you an example, Jason, of one that I haven't done it yet, but I do commercial lending for friends just because I've done enough loans and it's not that hard for me to do it. So I just did a deal for a maxillofacial surgeon who, kind of a long story, but he went through a really horrible time, and then we're repurchasing the property now back for him. So let's just say it's $1 million for his, but he has a lot of build out in there. So this is a little bit different than an apartment deal, but I'll just give you the easy way to calculate cost segregation on a high level, and then for your listeners, and then they can get more specific. So basically 15%, according to the county tax assessment, you can see the ratio between the land and the building. That kind of gives you a good idea of how much you can depreciate. As Jason said, you cannot depreciate the land. So in this case, since it's a condo, the land part is very small. It's only 15% of the value. So 85% of that is about $842,000. And the first year, he'll be able to take approximately 20% with cost segregation and depreciation. And so that's almost $170,000. And being in the 40% tax bracket, that's going to save him $67,500. Now, what happens is most CPAs, Jason, do not know about cost segregation. I would say the majority of them do not know about cost segregation. So I would recommend that you go with a cost segregation company that is really, really good. And the one that I work with they were the first and foremost is CSSI. Okay. You can look them up. And it's also not about getting the cheapest one, because this study for him, it might cost him $5,000, but he's going to have almost $70,000 of savings, and he can write off the $5,000 fee. So it's well over a 10 to 1. Sometimes it's 20, 30 times to 1 what you pay for maybe even more. Jason's probably seen even more for the study. So you'd be crazy not to do it. And also I would recommend, and I think Jason said this, but I would recommend that you get this before you buy the property. You get an estimate so you can do your calculations on the savings and have somebody review your projections and how much you're going to get in the savings on cost segregation. Because in some cases, Jason can opine on this, that, if you have $5 million in equity on a $20 million deal, hey, they might get $4 million of depreciation the first year. And then you can also allocate that depreciation to whoever you want in your group, I believe. Jason can opine on this. So if you want to give it all to the limited partners because they have a higher tax bracket or something, that's another way for you to help structure your deal, how you're going to allocate that cost segregation, the depreciation. So, yes. And then, of course, again, I'm not giving anybody any tax advice here, so you need to consult with your CPA. I just want to make that disclosure, okay? Because Jason would make me do it if I don't. But if the property, so typically in cost segregation, you take a house and like the windows maybe have a 15-year life, the door has a 5-year life. Just for example, like Jason said, the countertops have maybe a 10-year life. So those pieces will get broken out. And then if you own the property 7 years, all the stuff that you depreciated up front on the 5-year stuff, I don't know how that works on the recapture, because you exceeded the lifespan of that already. Even though you took it up front, you sold it past the useful lifespan. So basically it's sort of like an omelet, right? An omelet could have green peppers, onions, bacon, cheese, and the eggs. And the eggs are like the shell. Okay, that's going to have most of the 27 and a half year. But the green peppers are the windows. The bacon is the appliances, and all that stuff has a much shorter life. And technology changes too. So you may want to go back, in the middle of owning something and review that study and see if you've replaced a bunch of stuff. Maybe you could take some additional deductions, especially if you're doing like rehabs. Okay, if you're going in and you're rehabbing 80% of the apartments, you need to calculate that in when you're doing your cost segregation. Also, just as a little trick I learned a long time ago, if you're replacing the roofs, again, I'm not giving anybody advice, but I get one price for tearing the roof off because that's an expense, and I get one price for putting the new roof on. So I expense all the costs of tearing the old roof off, and then I get a separate invoice for the new roof. Usually, it all goes into one number, and that the cost of tearing the roof off is you're paying for that over 27 and a half years with straight line. Why would you do that?
Yeah, and with bonus depreciation, you can just you can expense the whole thing, or no, actually that can be on the capex right to the income. I like it. All right, that's a great tip there, Jim. I appreciate that. That's what you're talking about, right? I want to make sure I understand it, right? But you just expense the whole thing, so it goes right off deduction from the income.
Well, the roof are typically going to have a 15 or 20-year life, so whatever the guy who puts that on there, that would go into your cost segregation study. But if you're planning on replacing some of that stuff in your plan, it's good to talk to the cost segregation guy about what your redevelopment plan is as well, because that's going to affect how they're going to approach your cost segregation study.
Awesome. Got it. No, good stuff.
You could be making some serious mistakes. Okay. For example, if I'm replacing all the appliances in year one, okay, then I don't really have to put it under a cost segregation study because I'm going to break it out in my acquisition price, but then when I take them out, I'm going to write it all off, but not under cost segregation necessarily. Would be just that they're no longer useful, and I replaced them with something else. And here's the invoice for the GE profile set of stainless I put in this unit.
Yeah. That's what the good CPAs get money for, right? To know what to.
Right, but CPAs are not engineers. This is an engineering study. I want to emphasize that it's not a CPA study. Okay, you really need.
I'm talking about the differences between what they're going to use for in cost seg versus your expenses.
Yeah, so if you go talk to a lot of CPAs and you talk about cost segregation, their eyes may gloss over and they may never have heard of it. Now that's shocking, okay? But just imagine if you're a CPA and the tax code is 61,000 pages long. There's no CPA on the planet that understands the entire tax code. So understand, like if you're going to a doctor, he may be a general practitioner. That's sort of what a CPA is. But what you want to do is you want to go to a specialist for depreciation, and that would be a cost segregation person. Whether you know me or whether you use me or somebody else, my point is Jason is absolutely right. You would be crazy if you're going to hold the property for 5 years or more, even 3 years, not to do that, because you can use 1031 to shelter that bonus depreciation. So sorry, Jason, I talked too long, but
no, that's good information. That's why I like doing this, because I'm able to learn from people. Like, I didn't know you specialized in that, but awesome. Good deal, man. Thank you for sharing that, Jim. Thank y'all for tuning in and learning about this. So hopefully, we're in the weeds a little bit now, but overall, the takeaway from this is just like, hey, it's huge. It's a lot of savings that you can do, and you're leaving money on the table if you don't understand this. So use it, reach out to a reputable cost segregation study company, as Jim mentioned, and then also get a CPA that understands this stuff so that you can give yourself and your investors the best tax savings possible. All right.
Your cost segregation company should be able to go in and talk to the CPA about what cost segregation is and not charge you, because they're making money off doing a study for you.
Absolutely. Cool. And also Jim put in CSSI, which you can look them up. That's another cost segregation study. So, all right, with that being said, I am getting out of here, folks. I hope you found this useful. If you are looking for help and you're like, hey, how do I get started in apartment complexes? I don't know what to do with cost segregation studies and try to get started, or even perfect your skills and reach out. We got something pretty creative that we're doing right now. Other than that, enjoy your weekend, make it a great day on purpose. Be the best version of you, because it'll make you the happiest, and I'll chat with you next week. Take care.